Most investors play a waiting game. They buy shares, put them in a portfolio, and sit on their hands, hoping the line goes up. This waiting game exposes a critical gap between the growth you see on a screen and the money in your bank account, the distinction between unrealized and realized gains. While you hold that stock, every peak and valley on the chart is a calculation of potential. A surge in the share price is paper wealth, locked within the asset itself. Until you execute a sale, you haven't actually captured a profit or sustained a loss. But what if you could force those idle shares to generate cash today without liquidating the underlying asset? Transitioning from passive hope to active cash generation is the foundational purpose of the covered call strategy. To start building this engine, you must already own exactly 100 shares of a specific stock. These 100 shares serve as your collateral. They cover the risk of the transaction, providing the security needed to back the contract. With that collateral secured, you go to the open market and sell a call option contract against your position. This contract gives a buyer the right to purchase your vaulted shares at a specific strike price by a strict expiration date. In exchange for granting that right, the buyer pays you a cash premium. That money moves instantly into your account. This strategy prioritizes the revenue received right now. You keep that cash regardless of how the stock price fluctuates in the future. Selling the option converts a static, idle asset into immediate, tangible cash flow. This timeline represents the expiration date of your contract. At this point, the outcome is dictated by the market. In outcome A, the underlying stock price remains below the agreed-upon strike price. Because the price is low, the buyer does not exercise the option. You keep your 100 shares along with the cash premium. With the shares back in your control, you can immediately sell another call, restarting the revenue cycle. Now, consider outcome B. In this scenario, the stock price rises above the strike price. The option is now exercised. You are mechanically forced to sell your 100 shares to the buyer at the strike price. This transaction is what physically moves you out of the underlying stock ownership. High or low, the mechanics provide a strict, emotionless system that prioritizes guaranteed upfront revenue over holding onto an asset indefinitely. Being moved out of the stock triggers a realization of your gains or losses. The numbers on your screen are no longer theoretical. They are settled capital. If the stock was sold at a point lower than your original purchase, you realize a capital loss. This chart shows the recovery mechanism. Even if a sale triggers a loss, you can wash it out by repurchasing the asset at a lower price. This establishes a lower cost basis. You are back in the stock, ready to sell calls again. Traditional investing often involves agonizing over daily price fluctuations. This strategy replaces that anxiety with a continuous cycle of moving in and out of positions to harvest cash. Financial control comes from moving past the illusion of paper wealth and building a mechanical engine designed solely to generate realized revenue.